In the meantime, let's bring in CNBC contributor Greg Branch of Veritas Financial Group, who undoubtedly has come on today to say, Scott, I've changed my view. I've turned from a bear to a bull. All the calls about the Fed hiking are over. I'm more positive on stocks than I've been in months, correct?
Oh, Scott, you know me better than that. I wish I could say that, but that is not my message today.
Now, why? Why isn't that your message today?
So I will put it in the context of the things where I disagree with Gabriela, actually. I think that the Fed has gone out of their way. In as much as everyone declares that this war is over and the rate hikes are done, they keep going out of their way to reserve judgment, to have us keep an open mind that if the data starts going a different way, that they will raise again. The part of the narrative focused on cuts, and by the way, I think that cutting because they can is a luxury that you and I can talk about, but that the Fed does not have and does not enter their mindset. But the narrative, the part that narrative missed, the part that it skips over, is that we haven't even seen the full effect of the 500 basis point raise yet. And the fact the where the correlation is broken down is not necessarily in the demise of credit, because we've seen credit growth fall off a cliff, but it's in the spending. We haven't seen the spending react the way we would necessarily expect from a 500 basis point hike. We haven't seen companies in terms of jobs in the job market affected the way we would expect. And the question becomes for the Fed, is that delayed? Is that structurally muted? But that question has to be answered first before we can get to any discussion about rate cuts. And when we get to that discussion, it will be because they have to, not because they can. Because they can is reserved for a time where we haven't seen generational inflation and we're not worried about it coming back. Now, in terms of that fight being over, I think that that's difficult to pinpoint when we haven't really seen significant disinflation in quite some time. We've been stuck in a 30 to 40 basis point core range for the last 16 months, absent 3 months, one of which was last month. It remains to be seen if 20 basis points is the new trend, but we certainly can't extrapolate that off of one day.
All right, I'm going to let Gabriela respond. Let me let Gabriela respond first, and I'll come back to you, Greg, in just a moment. What do you have to say to that? Because, look, Greg's not the only one who has a more cautious and bearish view who suggests, look, everything that the Fed has done, I know you think it's all fine and good now, but it's not going to be. It's just a matter of when, not if.
So I do think the Fed will beat this drum that the inflation fight's not done quite yet when they release their decision and their dots and their press conference on Wednesday. And hence this idea that rate cuts are likely to come more mid next year, not quite early next year, and the Fed's not going to want to front run that. But I think there's two interesting debates here that Greg brings up. Number one, can inflation come down, because a lot of it were supply chain issues and not structural changes that makes this an economy more inflation prone. So can you have growth without inflation? We would say yes. And the second question, which is around the lag of higher interest rates, right? Are we yet to see it, or have we learned this year this economy is less interest rate sensitive than it used to be? And we're more in the latter camp, hence why we have a more constructive outview next year, including the Fed cutting.
That's right, Greg. Maybe it is just different this time. And there's so much focus I hear from you on what still might be. At some point, you have to focus on what is. And the might be may not happen. The only might be is that the stock market may continue to go up despite some of the concerns that the worst is yet to come.
That may be right, Scott, except we are seeing signs that it is starting to happen, but in a delayed sense. And so we are seeing signs of the consumer balance sheet being stretched, with delinquency rates rising, with the second derivative rising at alarming rates. We are seeing signs of corporations being more discriminating about their hiring, or at least adding jobs. Yes, while we don't have 12 million in terms of JOLTS opening anymore, 8 million is still a healthy number, and 200,000 of job ads is also a robust number when the break-even number is around 100%. And so we are starting to see on the fringes the impact of those rate hikes. And so I would not at this juncture be comfortable saying that we're just not going to see it anymore when we see it happen.